Traders rely on indicators to help execute their trading strategies. There are many indicators out there, but how do you know which ones are the best for you? Well, every trader will tell you something different. Some like to look at market momentum, while others want to filter out market noise or measure volatility. In this module, we will review 3 popular indicators widely used by traders. The first is called Relative Strength Index, also known as RSI. It's a momentum indicator that shows whether an asset is overbought or oversold. It does this by measuring the magnitude of recent price changes. The data is then displayed as an oscillator that can have a value between 0 and 100. Since the RSI is a momentum indicator, it shows the rate, or the momentum, at which the price is changing. This means that if momentum is increasing while the price is rising, the uptrend is strong and more buyers are stepping in. In contrast, if momentum is decreasing while the price is rising, it may show that sellers might soon take control over the market. A traditional interpretation of the RSI is that when it's over 70, the asset is overbought, and when it's under 30, it is oversold. As such, extreme values may indicate an impending trend reversal or pullback. The second indicator is called the moving average. A moving average smooths out price action by filtering out market noise and highlighting the direction of the trend. The 2 most commonly used moving averages are the simple moving average and the exponential moving average. The simple moving average is plotted by taking price data from the defined period and producing an average. For example, the 10-day simple moving average is plotted by calculating the average price over the last 10 days. The exponential moving average, on the other hand, is calculated in a way that gives more weight to recent price data. This makes it more reactive to recent price action. The moving average is a lagging indicator. The longer the period, the greater the lag. As such, the 200-day simple moving average will react slower to recent price action than the 50-day simple moving average. Traders often use the relationship of the price to specific moving averages to gauge the current market trend. For example, if the price stays above the 200-day simple moving average for a prolonged period, the asset may be considered to be in a bull market by many traders. Traders may also use moving average crossovers as buy or sell signals. For example, if the 100-day simple moving average crosses below the 200-day simple moving average, it may be considered a sell signal. The last indicator is Bollinger Bands, a measure of the volatility of the market. It can also be used as an indicator of overbought or oversold conditions. Bollinger Bands are made up of 3 lines, a simple moving average, which is the middle band, and an upper and lower band. The settings may vary, but typically the upper and lower bands are 2 standard deviations away from the middle band. As volatility increases and decreases, the distance between the bands increases and decreases as well. Generally, the closer the price is to the upper band, the closer to overbought conditions the charted asset may be. Conversely, the closer the price is to the lower band, the closer to oversold conditions it may be. For the most part, price will stay within the bands, but on rare occasions it may break above or below them. While this event may not be a trading signal in itself, it can act as an indication of extreme market conditions. Another important concept of the Bollinger Bands is called the squeeze. It refers to a period of low volatility, where all bands come very close to each other. This may be used as an indication of potential future volatility. Conversely, if the bands are very far from each other, a period of decreased volatility may follow.